Good afternoon, y'all. You are checking in with the Sit Rep podcast, where we help you win in real estate. And today's guest is no other than Constance from Military Mortgage Group.
Hello.
And broker at Remax Liberty. And today we're going to be talking about 5 essential things that happen in week 3 or approximately in week 3, utilizing the VA home loan entitlement. And then you can use this across the board, whether you're using FHA or VA. The last time that we were on the podcast, we talked about a couple of things. We talked about week 1, week 2, and now we're transitioning into week 3. Now, the first thing that we're going to go over is we want to talk about, now that the appraisal is back from underwriting, what typically happens from a loan perspective?
Well, you're working on the approval, so you typically would have gotten the approval by now as well. And so now you're working on the conditions, satisfying what the underwriter is going to look at. So that's always sometimes can be a tenuous situation because a lot of it is subjective. Most loan products, VA, FHA, conventional, have their basic guidelines, but then there's a human person that does look and interpret and to confirm, all of the items being what they need to be based on the guidelines. So you're dealing with a real person, the underwriter. So, it's always fun, a lot of fun.
Right.
Dealing, we love them, we do. But it is important for clients to understand that as a loan officer, we then become the middle person and that we are trying to satisfy what the underwriter is asking for. And that is verifying that this particular borrower has the ability to repay the debt. That is what it's all about, is evaluating the credit worthiness and the ability for that buyer to repay, the debt. So, so underwriting can be fun. One of the things that I always want to think about, though, is to make sure that you don't change anything about your finances. What you put in, what you started with is what you need to finish with, meaning everything kind of goes on hold once you go into underwriting. You don't want to acquire any new debt. You don't want to have any large deposits or large expenses.
So, Connie, basically what you're saying is that they need to eat bread and water, drink water. You can't go out to eat. I mean, what's going on with that situation? What typically do you see? What typical repairs do you see that will negate issues from a lending perspective? What are some common things that you see pop up during week 3 after the appraisal gets back, with the exception of the low appraisal? Because last time we talked about Tidewater appraisal and how that works. But what's the difference between a conventional loan, a FHA loan, and VA loan? What are some of the things that you've seen in the appraisal that would change things?
You mean the underwriting guidelines?
Right. Some of the underwriter guidelines for the VA.
Well, the big thing is just really, again,
I know termite clearance, right? But
you do need termite clearance. You got to have the underwriter sign off on the appraisal value. But some of the main conditions are, in terms of the borrower, is that they want to make sure that everything stays stable, because we do have to get updated documents, updated pay stubs, updated bank statements. And if any of those bank statements may show something different than what was originally submitted, that can cause either additional conditions or it can cause possibly the file not to go through. So that is why I tell all clients, whatever behaviors you were doing before, just keep them the same, because you don't want to have any differences. The big things are the large deposits or large expenses, because they also need to verify that you have enough money for closing. So, if there is a balance for closing, they're going to pull that last bank statement, get that most recent transmittal to make sure that they have enough funds to close. And then if there's a huge, deduction, they're going to want to know why, or say a deposit that they can't verify, they're going to want to know that as well. So you got to be very consistent with your spending habits, especially when you get into escrow, and definitely don't acquire any new debt, because what people don't know is that they have the ability to do what we call a soft pull, to do an update on your credit report to see if there's any new inquiries. And if that happens at the last minute, they're going to want to know what is it and verify that there's no new debt.
Now watch this, y'all. Do not buy any new cars while you in escrow trying to buy a home.
Or furniture. Or appliances. And literally, it's not even, you need to wait until your agent tells you that home has recorded. Do not purchase anything, new.
That's good.
And if you do absolutely have to do something, make sure you check in with your loan officer to make sure that you have enough room to be able to do it. Because emergencies do happen. Trust me, I've had to have people delay, getting their dog's leg fixed and everything until after escrow because it was going to cost too
That's
much.
crazy. Now,
It happens.
Now, I do have a question about the underwriter, right? So, what is a conditional underwritten approval, right? So, when you get in underwriting, they come back with conditions. Can you explain that really quick?
Yeah, so conditions are just additional verification of what has been originally submitted. Or sometimes circumstances can require additional documentation. For example, let's just say you're divorced and, let's say you didn't submit the divorce decree. Then they're going to want to make sure that you are divorced because California is a community property state. Therefore, debts are shared, or we have to take the necessary steps to separate the debts of the individuals. That's one thing that people get a lot confused quite often is that in a community property state, when it comes to VA, if you just because you're separated doesn't mean that though the spouse's debts aren't considered. They are considered. You can use, if they're working, you can omit them by, showing that they can cover their own debts. But it is something that does absolutely have a process in order to separate the two people, even if they are going through either separated or even going through a divorce.
Okay, good. So week 3, all right, appraisal's back. Okay, approval from the underwriter is back. Now there's a credit or something that is requested for repairs from the realtor. I know that gets mixed up sometime when you get credits. Why is it important for that real estate professional to get that back to you in a timely manner?
Well, because we need to know. We need to know what type of financial implication that's going to be, if there's going to be a credit to closing, or if there's going to be a credit direct to the whoever needs to do the repairs. So it is important because when we have to balance, the closing statement, we need to know, what that's going to look like.
Now, in regard to this market, I know there is a correction happening right now, y'all. We can see it real time. So for those of you who were trying to time the market, it's very difficult to do that, but there is a correction. We're starting to see a lot more properties stay on the market a little bit longer. That means it doesn't mean that the market is going to crash. What that basically means that the market is returning to normal, okay? So now the EMD, the earnest money deposit, a lot of times the agent will communicate that they're going to get the money back. But what happens when they have that earnest money deposit and there's closing costs involved? Can you discuss closing cost and why it's important to know what month that you're closing in regard to the prepaid taxes and everything else?
Absolutely. That has a huge bearing on what ultimately those closing costs are going to be. Because depending upon how far or close you are from the 2 times that you have to pay property taxes will impact how many months we have to collect in advance. So meaning, I think January, February are usually the lowest cost months because it's 3 months in prepaids that we have to collect. And then you'll get to the fall where August, September are the highest months where they're very high. You could be 6 to 7 months prepaids collected. And so that changes the amount of closing costs in terms of, because those prepaids have to be allotted into the escrow to start that client's their new mortgage. So if you're a strategic person, if you're a strategic buyer or even agent, sometimes you can time it just right, or sometimes maybe even delay a closing for those closing costs to be a little bit cheaper depending upon what that next month prepaids may include. So that's a little strategy. Sometimes it works out, sometimes it doesn't, but it does impact the amount of closing costs. Now, the EMD itself, that is an earnest money deposit. That is basically the good faith money that a buyer puts into escrow to allow the seller to take the house off the market. But those monies either can come back to the buyer and or be used for their closing costs. So in the market like today, so it's not really fair to say, oh, you're going to get your earnest money deposit back. You're going to get your earnest money deposit if you have enough credits to cover your closing costs. If not, that buyer still has to come in with those closing costs, and that money that's in escrow will be allocated to the closing costs. So you have to be very careful, especially as an agent, when you're talking about the refund of an EMD. You want to make sure that you're communicating with your loan officer to see what the situation is for that particular buyer.
And then in most cases, this is where a lot of real estate professionals make the mistake. They're not communicating with the loan officer, And this is why it's essential for you to be in thorough communication with the loan officers, because sometimes you'll get in a position where the real estate professional is communicating that you're going to get your money back, and then you have the rates change, or closing cost credits are not available anymore from the lender perspective. And I definitely want to cover that. That's going to be our hot chicken nugget coming fresh out of the Chick-fil-A grease today. We want to talk about lender credits also, and then we're going to shift over and talk about loan disclosure and locking the rate next. So what exactly is a lender credit? Can you explain that? And then can you kind of go over what certain institutions will kind of say they're going to do? Because I know in most cases that real estate professionals that you get with major institutions, right? I can't really say because I don't want to talk about anyone, but they'll say they'll give you a lender credit, and the rate might not be as competitive. Why is it important to sit down with the loan officer and the realtor and explain the closing costs?
Well, it's super important because that ultimately is going to affect, the client's ability to complete the transaction. When it comes to VA, one thing I want to be very specific is that, yes, there's no down payment, but that doesn't mean there isn't a cost to purchase, meaning your closing costs. And so sometimes people will get that confused and think, okay, no money down. Well, yeah, no, there is no money down, because any other loan, you do have to put some money down towards the principal. But there are still additional expenses to purchasing a home, meaning closing costs. So that, and the closing costs are compiled of your title escrow fees and your prepaids, your prepaid taxes and insurance. So that's the majority, and any lender fees that you may have to pay. So the key thing is when it comes to lender credits, and that's where the pricing of the loans, and where really one lender can be more competitive than the other and offer the same rate, is what is the cost of that particular interest rate? Does it cost the buyer something, or is there a credit? Meaning, let's just say it's 3%, no cost, no credits. And say a client could choose, say, I'll take a bit of a higher rate, and then they'll get a credit. Meaning that particular rate allows for there to be additional funds available to then be credited back to the buyer to cover their closing costs. Or let's say I want a 2.75, and say that may be a cost of, say, $2,500. Then that client would decide, saying, okay, I want the lower rate because over the course of time, my payment will be cheaper, and then over the course of time, I'll be able to recoup that, say, after year 2, and then, so that could make sense. So that's kind of the difference between a cost or a credit, and kind of how those work when it comes to helping out buyers. But also, it also depends what kind of market we're in. In this transitioning market, whereas just a year ago, most lenders could cover almost all of a buyer's closing costs by just increasing the rate a bit. Now, because the cost of money has increased, it's become more difficult to do that.
That's really, really good. So now that we've covered the lender credit, let's discuss the loan disclosure and locking the rate. What does that look like? What is a loan disclosure, and why is that important? And why is it important to lock the interest rate?
So loan disclosure is really important. I think we kind of went over that a little bit in our last podcast, because it does show you what all of the breakdown of other fees and everything. But closing disclosures, loan estimate, they're very similar. But what's important is that rate is locked. So if a loan officer has communicated to you a certain rate, let's just say 3.5%, you want to ask them, hey, have you locked my rate, or is it floating? Because rates do change daily. So if that rate isn't locked, there's no guarantee that that rate will be there. So it's very important to understand, especially when you're going through the pre-qual process, that those rates could change because they're subject to that day and that day only. So it's really, the conversation really needs to be had once that client goes into escrow. And sometimes we do have to reevaluate the rate because they may have gone up, or in some cases they go down, which we love. But we haven't seen that a lot lately. But with that being said, that's the important. Your rate is not your rate until it's locked. And there is a spot on the loan estimate as well as the closing disclosures where you'll see a little checkbox, rate locked. So that's something that you can just look out for as a client, to know that your rate is locked and you're guaranteed at a certain price. But yeah, it's really important. And locking rates is kind of it's a thing as loan officers, we kind of have that intuition over time when we know when it's a good time to lock, because you are educated on the market shifts. And that's something a good loan officer literally pays attention to that daily. Like, I wake up 6 o'clock in the morning, every morning, I know what the rates are going to look like. And I get indicators throughout the day if they're getting better, if they're getting worse. So then I can do the best for my clients and get them locked in at the lowest rate, given the time frame that we're working with.
That's good, man. That's your chicken nugget for today, man.
Yeah.
Make sure you guys working with a loan officer and a real estate professional that understands the power of locking the rate, because if they're not looking at those rates, then it might cost you. And then also rates can expire and that could cost you as well. Can you go over that scenario?
It can. So your rate is good for a certain amount of time. So you can lock for 30 days, 45 days, 15 days. The shorter your lock period, usually the better the rate, or the better in terms of cost. So that's one thing to think about. If you're in a 30-day escrow, typically, we'll lock for 30 days if that rate's available when you go into escrow. Now, there's nothing wrong with floating the rate during the actual approval process, but that is up to the loan officer, who should know what they're doing, to say, okay, I know that I need to wait a week, or maybe it'll get better next week. And then if all else fails, okay, it is what it is. But that is when you stay in good communication with your clients and let them know, kind of educate them a little bit on the market, on, kind of what's going on.
Now that we've discussed the rate lock, let's transition over to no large deposits and why that's important. You kind of covered that briefly, but let's just say Granny wants to give, the buyer, some money, and it's under her mattress. Why can that mess the loan up?
Absolutely. Any large cash deposits, and I mean large, like over $100, a lot of investors will want them to be sourced to find out where that money's coming from. It just goes back to, the thought process of, government wants to know where all the money's coming from.
Yeah.
Just like, that's really what it comes down to be honest with you. Does it matter to me? No, but it matters to them to make sure that all these funds, number one, were taxed. And that's really what it comes down to. They want to make sure that these funds at some point came from a legit source and didn't come from, something, illegal or nefarious.
That's good, man. And, in closing now, you're transitioning into week 4, right? And then you're going into closing. So there's a couple of things that are essential. And then week 4, we're going to come back on the podcast and have you on here. We're going to talk about getting to the closing table,
yes.
Getting that closing disclosure and what that looks like. How can realtors, what advice would you give realtors on helping the loan officer get to that finish line, with the exception of communication?
I would honestly, as a realtor, not to say that realtors ever, some realtors do become loan officers like myself. I've been doing both since the beginning of my career, and I feel like that's what's made me actually a better agent. But what I would encourage is just for agents to learn the basics of the process, so you can not only...
No, hold on now. Give me 3 basics now. Give me 3 basic things. We can't just get you out the podcast. You got to tell us, what do you want those realtors to know when they're coming to Connie? How can it help Connie? What information do you think they need to know, with the exception of how to do the monthly payment? Is there anything else that you would add to that?
Well, I would say to understand the basic guidelines, just basic of knowing, okay, if I have a buyer here, I know what they're going to need. If I have a buyer who has a situation, let's just say they're separating, going through divorce, I am able to share with them, hey, these are the things that we're going to need, documented, in order to make it a streamlined transition for one of the individuals to purchase. Because that seems to be one of the biggest things that come up pretty often that can kind of throw a little monkey wrench in the situation. Because the reality is, if you're not in good communication, even, and sometimes, divorces, separations can be, heated, then it makes it very difficult to go through the process. So the more that you can team up with your loan officer to support them, the better. Because you don't want to, as an agent, you don't want to waste your time either in a situation where, listen, if you're not going to get cooperation, there's not really much that you can do. So that's the key thing, is to be able to at least know enough to be dangerous. Not to say that you're going to originate a loan, but enough to also inspect whether or not your client is also getting the best deal or being treated properly on the other side if you don't have a relationship with the loan officer. Because as much as we like to work with people we like, if a client comes and they want, to use their Uncle Sal to do the loan, then, hey, we have to let them do that. But let's say Uncle Sal may not be the best. As a real estate agent, you want to know enough to be able to say, I think something may be going a little sideways here. Or even be able to work with your sellers to be able to time things when it comes to, even representing the seller to be able to gauge, hey, is this loan process over here going smoothly? So, it's just the more knowledge you have, the more powerful you can be. And I think a better support and value to your client.
Got you. Basically what she's saying is, hear ye, to all of these seasons greetings. Make sure you disclose all material things to the VA loan professional and the God. No, I'm joking, y'all. She's going to find it. So listen, if there's a situation to where you know that you're going to have some issues, and look, a call to action for you real estate professionals out there too. You need to know the loan process, a little bit of it, and you need to know all of the paperwork to help the loan officer get to the finish line. Yeah. Okay, because guess what? That mortgage professional is an X-ray or MRI technician. It is going to come up. Child support, late payments if it's not on your credit, liens or encumbrances on the property. You cannot transfer that property without disclosing all material facts. If there's something, if you got an account that comes up that's tardy, if there's a late payment, it is going to come out and it would prevent you from closing. So you can't blame the loan officer if you don't tell them up front. Okay. That's right. So do you have anything to add to that as I pass the mic over to the VA God?
Goddess. Got it. No, I'm just kidding.
Goddess. Sorry, my bad.
Now, one of the big things is just, it's teamwork, especially when it comes to the agent and the loan officer. And even if you're on the other side, even if it's, sometimes what frustrates me the most is I don't know why people act like in this business we're all not trying to get to the finish line. Yeah. So it's even with, if you are the buyer's loan officer, buyer's agent, working with the seller, make sure you just communicate. That is the key to, creating great and long-lasting relationships. And if there's a problem that comes up, most of them can be solved. Well, and so it requires a spirit of teamwork on all sides. Amen. To get to the finish line. Come on now. So that's my best tip is if you're a listing agent, give the buyer agent loan officer grace, figure out how you guys can work together. And flip side, as a loan officer and buyer's agent working with the seller and, to get to the finish line, and always be open to learn. Trust me, I'm learning something new every single day. So, and just, you guys got to team up to get the honesty from the clients, because sometimes they don't tell you everything. If they show up in a new car, you better ask them, hey, you got a new car? Did you tell your loan officer? So you always want to have each other's backs through the transaction. Come on, Connie, snitches get stitches. They can't be telling you about the new car, man. And you also will not get to the finish line either. And you would have spent all this time out there back to your apartment. Around. You'll be driving back to your apartment with that new car and not at a house. And you can't blame the loan officer or the realtor because you didn't let us know. Right. So buyers out there, do not buy anything of any large purchases during the escrow period. That is, yes, that's what I'm gonna leave you with. The loan goddess has spoken, y'all. Yes. The word is ordained by Anthonyus Glenius, the VA loan god. All right. From the Sit Rep podcast. Yes. Until next time. All right, so check it out, y'all. So Connie is always an amazing. So we got through week 1, week 2, week 3, how to find out about what veterans are supposed to do, and people, just buyers in general, and the information. We're coming to a theater near you with the last and final podcast in regard to the best things in regard to each week and what you should be expecting when you, as a first-time home buyer and a VA buyer. Constance. Yes. How can we find you? You can find us at militarymortgagegroup.net. Look us up. If you need any help, give us a call. We're more than happy. I work with an amazing team of loan officers, loan officer assistants, processors, and all that great stuff. And so we're just really excited to help our veterans out and really educate you and what's the best way to get into investing in real estate. Magnificent. And listen, y'all, call to action, wire10k.com. Click on the social media link. Follow us on Facebook, Wire
Facebook group. We're going to be pushing this content in there so you guys can learn. And we're going to be talking about that last and final week where you are transitioning to get from week 3 to getting the keys. And then also we're going to be bringing on a real estate professional, and they're going to be talking about week 4 and what that looks like and some do's and do nots in week 4. So stay frosty. Anthony Glenn, this is how you can reach me, wire10k.com. You can also reach me on Clubhouse at Tony Glenn II. Stay tuned for the next Sit Rep podcast, and Tony Glenn out. Stay frosty.